Okay, let's move on to the last topic, that is merits for international capital market performance. So let's consider the many sides of many. So let's evaluate the many sides of international capital market. The first one is the international portfolio equity diversification. But it's impossible to collect accurate data of on the contracts of all portfolios of residents of a country, because it's difficult to accurately measure the degree of international diversification of portfolios. But when we use some US data, we can get a rough idea. So let's check that. In 1970, foreign assets including housing held by the US students was 62% of the US capital stock in value. And the foreign holdings of US assets are 4% of the US capital stock. But then in the 2008, the US asset held by the US student increased to 46.6% of the US capital stock. This is huge number compared to the 2017. And the foreign holdings of US assets was about 55, 54, 54%, 54.7% of the US capital stock, almost over the half of the US capital stock. So the foreign asset held by US students increased rapidly from 2070 to 2008, from 1970 to 2008. But if full portfolio diversification is achieved, the ratio of the size of the US economy to the size of the rest of the world is realized as a transaction of foreign asset. So the number is 80% of the US capital stock. This is theoretical value. The US assets held of foreign US assets, US foreign assets held by US students increased rapidly, but it doesn't reach to the theoretical value 80%. So economists state that the potential gains from portfolio diversification are large, but the actual portfolio diversification level is lower than the theoretical value, 80%. Why is portfolio diversification stuck at lower levels than the theoretical level? So the reason is that one of the reason is home bias. Home bias is the propensity to prefer one's home country as investment destination. So consider that I'm a Japanese, and then I try to decide which country to invest. Then I prefer Japan to invest because I'm Japanese. So this is home bias. If you are Chinese, you want to invest to China, and you are American, you want to invest to the US. So this is a home bias. So next, consider the intertemporal trade. So Martin Feldstein and Charles Horioka, both are economists, states that in smoothly functioning international capital markets, national investment rates diverge from the national saving rates. So to understand this statement, we recall the clause in a clause. We need to recall the savings and investment relationship in the closed economy. In a closed economy, savings should be equal to the investment. So domestic saving equal to the domestic investment. So therefore, if savings increase, then investment also increase. Savings decreases, then investment also decreases. So S and I commove in the international in the sorry in S and I are commoved in a closed economy. So in a closed economy, S moves and then I also moves together. In an open economy environment, is domestic saving is not equal to the investment. S is equal to the investment plus current account. CA is here. So if saving increased, but I does not move, then but CA increase. Sorry. Please forget that. If I doesn't move, but CA moves upward, CA increases, but I doesn't move, then S increases. If I increases, but CA decreases at the same amount, then S doesn't move. So therefore, in an open economy, S and I does not commove. So S moves, but I sometimes moves but doesn't move. Okay? So S and I, the commovement of S and I does not appear in the open economy. Because savings are made in the most productive part of the world in the international capital market, then because the global pool of funds is available to finance investment. So in the international economy, the investment is made at the most efficient and profitable country. So therefore, savings are made in the most productive parts of the world. Okay, therefore, the relationship between domestic investment and domestic saving is broken. So domestic investment and domestic saving does not commove. But so this is a theoretical prediction. In the international financial market, so when the international financial market is open, then domestic saving and domestic investment does not commove. So this is theoretical prediction. But in fact, countries with high savings rates for a long time after World War II also had high investment rates. So therefore, long after the World War II, that is considered to be the high international financial transactions. Despite of high international financial transactions, the investment and savings are commoved. So this is puzzling. So therefore, this is called the Feldstein-Horioka puzzle. Okay, record that again. So S equal to the I plus CA. Because due to the existence of current account, CA, S, and I does not commove. Okay, this is the statement of Feldstein mentioned. But actually, S and I commoved in the real data. Why? The possible hypothesis is that the volume of CA is low, or the fluctuation of CA is limited, so small. It means that the level of international flows are low. Okay? So S and I does not commute because there is current account. This is theoretical prediction. Okay? According to the theory, S and I does not commute due to the existence of current account. But in fact, actual data shows that S and I commoves even after the long time after the World War II, the highly financially integrated period. Why S and I commove despite of international financial transactions? The one possible hypothesis is that CA here is small and the fluctuation of CA is small, which means that the level of international capital flows are low. So therefore, despite of today's financial integration, highly integrated financial countries, but the actual level of financial integration is low compared to the theoretical consideration. Okay? So this is the Feldstein-Horioka puzzle. Okay. Okay, so you can easily see that there is positive correlation between investment and savings in this figure. So in the horizontal axis is saving to GDP ratio. Vertical axis is investment and GDP ratio. So you can see that there is upward sloping relationship between savings and investment. So if savings up, the investment also up. Then savings go down, investment also goes down. So there is positive relationship. So therefore, actual saving and actual investment moves in the data. So this is Feldstein-Horioka's puzzle. Okay, let's move on to another topic, the efficiency of international asset price arbitrage. Onshore and offshore interest rates on similar assets denominated in the same currency should move closely if the world capital market shares information about the global investment. Then, large interest rate differences are strong evidence of unrealized gains from trade. Now, check the interest rate differences between onshore and offshore interest rate. Okay, this is the risk premium. This is the London 3-month euro dollar rate less US 3-month certificate of deposit rate. So the differences, so this is the difference of interest rate. So you can see that around before the 2006 to 2000, around the 2006, before the 2006, the interest difference is closely to zero. So there is no interest differences between offshore and onshore deposit. But during the global financial crisis, and after the global financial crisis, around here, there is huge differences between the interest rates of offshore and onshore rates. Why? Why there is so large differences between the euro dollar deposit to the dollar deposit? So this is due to the risk premium. During the global financial crisis, investors believed that while US money market instruments, including dollar deposits in the US banks, would be backed by the US Treasury and the Federal Reserves. But dollar deposits in London, Eurodollar, might not receive the same protection. So therefore, there is high risk premium in London Eurodollar. So this high risk premium, so this large differences reflects the risk premium of London Eurodollar. Okay, let's move on to the foreign exchange market. Exchange rate helps determine the profitability of international transactions of all types. Exchange rates send important signals to households and firms engaged in international trade and investment. Studies of foreign exchange market can be used to judge whether the international capital market is sending the right signals to market. Okay, so speaking of the inter-exchange rate determination, we recall the UIP condition. The uncovered interest parity condition discusses how the exchange rate is determined. And the UIP condition is like that. Interest rate difference is equal to the market's forecast of expected changes in the exchange rate. So this is UIP condition. If we replace E, the expected exchange rate, with actual future exchange rates at T plus 1, we can test how well the market predicts exchange rate changes. So if we replace these two actual future exchange rate, we can test that these interest differentials can predict. We can test this interest rate difference can be predict. Okay, so again. Sorry for that. Okay, let me explain again. So if we replace this term, expected exchange rate, replace into actual, if we replace this into exchange rate, future exchange rate ET plus 1, then we can test whether this interest difference can predict this future expected exchange rate difference. We can test this interest difference can predict this exchange rate growth rate. But empirical exercises show that the interest difference RT minus R star T fails to predict the exchange rates. So the interest difference cannot catch any of the large swings in interest rate in the actual exchange rate. So therefore, the UIP condition fails to predict the actual exchange rate. Now we introduce the forecast error people make in predicting future depreciation. UT plus 1 as like this. So the forecast error is actual rate of depreciation minus expected rate of depreciation. So if the market is making use all of available information, its forecast error ut plus 1 should be statistically unrelated to the data known to the market on time t. Can you see? Can you understand that? Okay, can you catch up with the discussion? Or if the market making forecast with all available information related to the exchange rate, like money growth, monetary growth, monetary supply growth, GDP growth, etc. Then its forecast error, UT plus 1, should be statistically unrelated to the data like GDP or money supply known to the market on data T. Okay? So then we can test the correlation between forecast error UT plus 1 and the actual data known to the market on data T. But how we test this UT plus 1, because there is exchange rate, expected exchange rate. So we cannot measure expectation. But if we can rewrite this expression by using UIP. So therefore, these variables are all observable. Then we can calculate UT plus 1. So then we can test the correlation between UT plus 1 and all data related to the exchange rate available until period T. Then result is forecast errors can be predicted. It means that past forecast errors which are widely known are useful in predicting future errors. It means that the conclusion may be the market does not to use all the information available at that date. So this can be conclusion. But wait a minute. So this is the standard UIP. Recall that we can introduce risk averse or risk premium. Recall that when people are risk averse, the interest parity condition is with the risk premium low. So there is low new term, which is risk premium, is in UIP condition. So under the imperfect offset substitutability, which means that people are risk averse, changes in risk premiums may derive changes in exchange rate. So since both expected changes in the exchange rates and risk premiums are function of expectations, and because expectations are unobservable, it's difficult to test if international capital markets are available to access and transmit information about interest rate. So the answer is unclear. Okay? If we use standard normal type of UIP condition, then the forecast data UT plus 1 and actual data related to the exchange rate available until period T correlates. So therefore, under the standard UIP condition, the market seems to be not use all information available at that date. But if we consider the risk averse agent, then UIP condition has risk premium term low. Then exchange rate depends on the interest rate difference and risk premium. We won't judge which condition, UIP condition or UIP with the risk premium low, is better for the actual data, but we cannot judge because expectations cannot be observed. Okay, therefore, we cannot say anything about the answer of the question, whether the exchange rate, whether the market predicts the exchange rate correctly or efficiently. So we cannot answer this question. Okay. Many studies or many researchers try to measure the expectations using microdata, but the answer is not clear. Okay. So the another topic of exchange rate is excessive volatility. Predicting short-term exchange rate is difficult because it depends on so many variables like money supply growth, government spending growth, GDP growth, and other fundamental economic variables. There are so many fundamental economic variables, therefore, it's so difficult to predict exchange rates. Then Richard Messi and Kenneth Logo found that the simple random walk property of the exchange rate. So random walk is like this. Today's exchange rate depends on the past exchange rate plus error term. So error term is basically IID normal distribution with mean zero and variance with sigma square. So the expected value of this error term is 0. Then we take expectation. The expected value of exchange rate is equal to the past exchange rate. Past expected exchange rate. So recall that in the expectation, so that using expectations operator, the past expected exchange rate should be equal to the past actual exchange rate. So gonna be EET minus 1 here should be equal to the ET minus 1, the actual exchange rate in the previous period. So therefore, today's exchange rate is forecast by the yesterday's exchange rate. So therefore, today's exchange rate is the best guess of tomorrow's. Okay, this is a property of random walk. And this random walk model fits good. This random walk model have good prediction of exchange rate. This model fits better. So let me explain the exchange rate disconnect puzzle. The challenge of understanding the remarkably weak short-term feedback links between the exchange rate and the rest of the economy. So exchange rates are so much volatile than visible economic aggregates like GDP growth, monetary supply growth, government spending growth, and etc. So exchange rates are much highly volatile than the measurable economic aggregates, fundamental variables like GDP growth. The possible explanation is that substantial and persistent deviation from UIP. But again, UIP depends on the expectation. So we have no good grasp of what causes them. So okay, so the possible explanation is potential and persistent deviation from UIP, like risk premium. But risk premium and also UIP depends on the expectation. But expectation cannot be observed. Therefore, we cannot grasp what causes them. We cannot understand what we cannot seek into the what causes them. Okay. Okay, as a summary, there is only the ambiguous evidence on the foreign exchange market's performance. If we judge this is good, market performs well, then laissez-faire attributes by governments and increased cross-border financial integration are supported. But if we judge market is failure, then it implies that a need for increased foreign exchange intervention by central banks and a reversal of the global trend toward financial liberalization. Okay, this is the bottom line. Okay. Oh, this is the end of the lecture. Sorry for today. Sorry for the today's lesson because my mouth is not good condition, I guess. Ah, I get tired. Okay, anyway. Okay, there are so many takeaways, so please keep in mind how did the global financial crisis occur, the reason behind the global financial crisis, and how did the damage of the crisis become severe, the background of severe impact of the global financial crisis. We also compared the difference between Japan's and Japanese GDP and US GDP during the global financial crisis. So we introduced Basel III and FSB, Financial Stability Board. And how did countries react after the global financial crisis? So please remember the local policies after the global financial crisis. So key important perspective is the macroprudential perspective. And the and also the Basel's multilateral consultation process tackles some of the financial trilemmas. We also reviewed the international portfolio diversification around the world, and we introduced the home bias. So we also learned how the Feldstein-Horioka's puzzle and the movement of the saving and investment. According to the simple UIP, does the market use all information available at the time T? So how does the answer change if we introduce the risk premium? So what process does the exchange rate follow? So this is random walk process. So what is the random walk process? So what is the exchange rate disconnect puzzle? So these are the takeaways. So please keep in mind. Okay. So this is the end of the lecture. I hope you enjoyed today's lecture as well. Okay, thank you so much. Bye.